Welcome to Indianomics. The June CPI number coming in at a 6.5-year low of 2.1% has led to a few things. One, most economists have revised down their average CPI forecast for FY26, this year that is, to 3.2 to 3.3% against Reserve Bank's forecast of 3.7%. Second, many are penciling in another rate cut. Third, most are not expecting it in August itself. And fourth, above all, bankers and bond dealers are watching Reserve Bank's liquidity policy. How much liquidity Reserve Bank will add or remove from the system and when will determine bond yields and the rate cut transmission. Now, equity investors in banks are still penciling in about 12% credit growth on hopes of a 10% nominal GDP. That may be up for threat. And they're also penciling in an end to the rate cycle. These are what equity investors are penciling in. So today on Indianomics, we have three experts to help us understand how growth, inflation and liquidity may pan out. I have with me Saugata Bhattacharya, Senior Fellow at the CPR, Center for Policy Research, more importantly, MPC member. Neeraj, Gambhir, the Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank, and Samiran Chakrabarty, Chief Economist at Citi India. Gentlemen, good morning and thank you very much for joining me in what's a very crucial conversation. Saugata, first your thoughts on the CPI number, deflation in food inflation and core as well, pretty much under control.
So hi, Latha, thank you very much for having me on your show. So a couple of observations. Yes, the CPI food overall headline and food inflation numbers came in a little lower than what markets had been expecting, but this has begun to emerge as a trend for the last 3 or 4 CPI prints. We have seen this happening. This, to my mind, is very much a one-off. One, as everybody now already knows, I mean, this is partially due to the base effect of a very high inflation print, 5.1% in June of last year. So the next two inflation prints are likely to be higher headline prints. Overall, we are in a very good place, very good position in terms of inflation. As you mentioned, I think inflation for the year is likely to be lower than the RBI, the current RBI forecast. So that definitely gives us room, gives room for the RBI, the MPC to continue with the easing cycle. It's just that the pace is unclear. On core inflation, which is what is probably important from a policy making point of view. I think the 4.55% that we have seen in June is likely to peak out, given the fact that base rates, the base effect of core inflation, has been increasing. So I mean, I don't expect a dramatic increase in core inflation, given the fundamentals that are driving core metals prices, commodities prices, etc., seem also to be in a good position. They are very unlikely, particularly crude prices, are unlikely to increase. So I think from the inflationary point of view, I think monetary policy is in a good position. But again, I mean, there are multiple other things to consider.
Okay. Well, Samiran, you're the person in the among the people I spoke to with the lowest inflation expectation for July. Your number is 1.1. So tell us your trajectory. Does it get much below what Reserve Bank has forecast in June?
Thanks, Latha. So yes, we are looking at a 1.5 kind of CPI for August, but this will be which will come out in August for the month of July. But this will probably be the trough on the inflation trajectory. We are now looking at the July-September quarter to be averaging about 1.9%. But at the same time, we think that all the stimulus that is going into the economy, that with a little bit lag will start impacting demand also. So we have actually built in a slightly higher momentum in core inflation for the last quarter of the year. And that's why our last quarter average headline CPI is marginally ahead of the RBI's current forecast at around 4.7%. Altogether, the full year average is about 3.2%. The critical part, which always is very difficult to forecast, is the vegetable price trajectory. But other than vegetable prices, I think most of the non-veggie food prices are behaving in a very benign way. So given how the monsoon has panned out, we think that trend is going to continue as well. So overall, it seems to be, at least in the near term, a very low inflation path that we are going to follow.
Okay. Neeraj, what are the markets expecting from Reserve Bank? If the number, as Samiran is putting it, is going to be 1 point something, maybe even lower than 1.5, will they go ahead and cut despite the neutral stance?
So I think given the inflation outcome and given what Samiran has said, I think the markets are broadly in line with the fact that the next reading is going to be a low reading, but after that we'll see some recovery in inflation numbers, some pull up in inflation numbers. But given the expected outcome on inflation, despite that, I don't think the markets are expecting a rate cut in August, as you yourself mentioned in the initial part of this program. The key reason is twofold. First is that Reserve Bank has already front-loaded a lot of monetary policy action. I think given what they did in the last policy, it was much more than what the market had expected. And I think with that size of monetary policy impetus given, I would guess the Reserve Bank would like to wait a little bit longer before taking the next step. Second is that the action on the liquidity front is also a little bit unclear. There is ample liquidity in the system. There is approximately 3 lakh crore surplus in the system currently. If Reserve Bank does not conduct variable rate reverse repo auctions, then all this liquidity will sit in the SDF, which is where the rate is 5.25. But if Reserve Bank continues to do VRRs and keeps on, it'll effectively pull the overnight rate up towards the repo rate. So currently the market is expecting Reserve Bank to continue with the VRRs and pull the overnight towards the repo rate, which basically means that, there is an implied 25 basis point hike in the overnight rates, right? So these are the two forces which are kind of playing out, which is why you're seeing bond market to be very stable at this point in time.
Okay. Yeah, I agree. Moving more towards 5.4, actually, the call rate from below 5.25 some time back. Saugata, I'm going to ask you two quick questions because you're not going to be with us after the break. Our discussion will continue. One is, how should central bankers think of inflation? Should they think of the fact that all through 2025, we are going to have 3% or below inflation, which means the real rate is more than 250 basis points? Or should they think of the 1 year forward, in which case 1 year ahead you may have a 4% plus? What should be the standard way of thinking?
So, I think this question has been settled in multiple papers, theoretical, academic discussions, and Samiran put it very clearly that it's not just the next couple of sprints, the next quarter. You have to look at it over the course of the year, probably across the cycle. Again, I still go by the RBI's forecast, but even there, it does seem to be on an upward trajectory after, say, from the third quarter onwards. So obviously, this is not. You hear the argument that it's best to cut the policy rate before start with another easing, make another easing move before inflation starts moving upwards. I don't think that's a correct argument because obviously the monetary policy easing cycle, as the name implies, is over the course of the cycle.
Okay.
So you have to consider that. On top of that, you have to look at various other measures which might impinge on core and headline inflation going forward. The inflation growth trade-off, global uncertainty, volatility, etc. So I think caution that I at least particularly keep talking about. I think that needs to be very much in place in looking at the path of monetary policy.
Okay. Let me pack two quick questions before you leave us. One, do you personally think that there is space? Because if you look at current inflation, there seems to be a lot of space. If you look at 1 year ahead, you can even argue there is no space. And the governor's statements can be interpreted either way in his interview to me. That one question. And the other one, would growth move the RBI more? And are you worried about growth? in the sense, the WPI number came in at deflation. It came in at minus 0.3. So, is there a growth scare as well?
So again, growth is definitely the impulses that you see, the data, the high frequency data that you see, definitely suggests that some ambiguity on growth. It's not very clear. I still go by the 6.5%, the forecast for FY26 growth. If we actually do grow at 6.5%, I think we are okay in this current market with the amount of elevated uncertainty that still remains. We have no idea where the overall tariff situation is going, where the trade situation is going. I think we are in a good position in terms of growth. Of course, we need to support growth given the space that the inflation trajectory even over the course of the year provides. But I think at this point in time, as Neeraj mentioned, I think the liquidity support that the RBI has provided, I think that's a far more critical thing in terms of looking at transmission, in terms of credit growth. In terms of credit growth, which is an important part of the monetary policy cycle target, the objective, I need to point out that it's not just bank credit. I mean, the overall flow of resources in the corporate sector, that's very, very, I mean, the amount of money that's been raised to the corporate bond market, I think is very, very, very high this time and is expected to remain high. Transmission has been faster in the corporate bond market. So, I mean, we need to look at the overall flow of credit, not just from the bank credit side.
Fair point. So you see space for a further fall in rates?
In short, yes. Okay. Yes, I see space, but that obviously depends on multiple factors going forward, particularly inflation.
Okay. Well, thanks a lot for that, Saugata. We'll take your leave. Neeraj, Samiran, please stay on. Quick break, and we are back with more questions. Welcome back to Indianomics. This one has been triggered by the ultra low or unexpectedly low CPI number that we got for June of 2.1, with a large part of the economists community now expecting the full year inflation to be as low as 1990 levels, 3.2%. The resultant impact on what RBI might do in terms of liquidity and rates is what we are discussing. We had Saugata Bhattacharya, the MPC member, plus Neeraj Gambhir and Samiran Chakrabarty speaking to us. Neeraj and Samiran, thank you very much for staying on. Samiran, if you can analyze the impact on credit growth, do you think that the Reserve Bank needs to do more in terms of both liquidity and rates to push credit growth? There are a lot of people who are expecting only single digits. Can Reserve Bank make a difference with liquidity?
It boils down to how you were looking at credit growth, whether you were looking at it from the demand side or you were looking at it from the supply side. Our sense is that the demand side is still weak on the credit growth front, and that's because of two broad reasons. One is that the interest sensitivity of segments of credit demand is often low. There are only a handful of them where the interest rate sensitivity shows up in a big way. And the second is, as Saugata was mentioning, the borrowers are looking at alternative sources of funding, including corporate bond, ECBs, et cetera, as well as a large chunk of equity funding, which is replacing probably debt funding. So I think the demand side would not be the trigger for credit growth to improve. But we should not be ignoring the supply side. There is substantial amount of liquidity that has been given to the banking system. At some point of time, the banks will try to offload this liquidity onto the system. This can happen through the NBFCs who have a larger feet on the street. So through the supply side, the first trigger for credit growth could come in. So I will not be surprised if the credit growth numbers inch up to 12-13% at the back end of the year when the full effect of this monetary transmission takes shape.
Okay. What's your sense, Neeraj? I mean, put on your banker's hat and think, what will a punishing amount of liquidity, every day bankers forced to give money to the Reserve Bank at 5/4 or even maybe if there is a rate cut at 5% to RBI, would that be trigger enough to force bankers to lend? In the last cycle, of course, it was very long ago, in the 2000 to 2004 rate cutting cycle, you did not see credit offtake up until 2004. It took 4 years. And then, of course, credit growth jumped to 25%. But rates falling from some 10% to 6.5% did not increase credit growth. Bankers remained cautious or borrowers remained cautious. What's your sense now?
So my sense is that hoping that this dose of liquidity and the rate cuts that Reserve Bank has done, coupled with the fact that government is doing spending on the capital side, there is some front loading of subsidies. So there is a push towards increasing sort of demand, even though I agree with Samiran, the demand side is looking a bit weak. I think all of these factors will combine to give us a better outcome on credit in the second half of this year. Currently, the credit growth is at about 9 or 10%, somewhere in between. And we will slowly inch up towards 12%. I still don't see it going significantly beyond 12-13% for this year because the demand from large corporates, the demand from overall corporate sector still continues to be somewhat weak. Now, when will monetary policy deliver? I think it's an open question. There is no clear timeline. I've seen at least 4-5 cycles now. Each cycle is very different. And the drivers of credit growth in each cycle are also very different. I think if you remember, between 2012 to 2014, the big driver was infra spending, right? So between 2017-18 to 2020, the driver was retail lending. So every time we've seen a slightly different driver of credit growth. We'll have to see this time around in the revival sort of leg of credit, which sort of segments play their bigger than usual part in terms of driving it back. But I think I would expect that as liquidity settles down in the system, as the rates settle down in the system, they have done to a large extent on the lending side, but also from banks' perspective, the cost of funds steadily comes down. There will be some impetus to bring the credit growth back towards 12-13% numbers by the end of this year.
Okay. A two-part question for you, Samiran. Actually, I'll put it in two separate questions. One, this 12-13% number is coming into question more because now the nominal GDP is going to be very low. If we are going with a 3.2% CPI and a lower WPI, then the nominal GDP perhaps will not even touch 9. It could be even sub 9. And then the credit growth, if it is 1.1 times nominal GDP or something like that, we may not get beyond, maybe barely make it to double digit. Is that an argument?
So first, we are not talking of kind of average credit growth here. Okay. We are talking more about what the credit growth would be, exit credit growth type of thing. And that, to some extent, will benefit from a bit of base effect of last year when in the latter part of the year, the credit growth actually tapered off. So from there, the favorable base should help. And, there are times when the system is trying to push higher credit. It's not for the first time that we will be seeing that credit growth will be substantially higher than that mechanical rule of X times nominal GDP growth. It could possibly be the case, but my bigger worry actually is that to what extent the non-banking channels of credit and equity would drive the financing rather than the banking credit. Fair. As Neeraj said, that there could be different pockets of credit that could emerge, not the traditional ones.
No, fair point. NBFCs are more nimble. And since there's a banking system is actually negative year-on-year terms in terms of their loans to NBFCs, maybe that route will fire. But Samiran, a more general question on growth. The Reserve Bank can be moved to cut if it genuinely perceives danger to growth. Is the 6.5 in danger? Is even 6.3 in danger in terms of growth rate?
Right now, for the April-June quarter high-frequency data, I think we are tracking somewhere around 6.5 only on GDP growth. We will get to see the corporate results now, which have a large bearing on the final GDP number. So we might have tweaked the number a little bit here and there to adjust for it. The open question is that when this tariff-related uncertainty settles down and whether the average tariffs settle down at 20% for US or at 25%, depending upon that, we might see the global headwinds. We have to consider that to what extent that creates a downward bias. But at the same time, I think the markets are generally underappreciating the size of the stimulus. There's a 30 basis point of GDP coming out of tax cut. Our estimate is 40 basis point of GDP is the immediate impact of the 100 basis point rate cut on household borrowing. And then there could be about 30 basis point more coming out of higher credit growth. So altogether, about 1% of GDP, monetary and fiscal stimulus is there in the system. So that should show up in numbers at the latter part of the year is what our call is. So not thinking that the growth outlook is necessarily very bearish.
Okay. There have been economists who are telling me that even in Q1, while latter part, even in Q1, if the normal GDP is C plus G plus I plus net exports, especially service exports, have done well. Goods exports were flat even last year. So in terms of input into GDP, exports have not taken away anything, plus government spending much better than last year. So we could get a good growth number. And therefore, we are coming to Neeraj's forecast or the bond market's forecast. If the expectation is that growth is not under threat, and the RBI argues in its own mind that when I go to the August policy, I will have a July CPI which will be 1.1, if you're right, Samiran. So there will be more pressure on me in August, so why should there'll be more pressure on me in October, so why give away the rate cut now? So be that as it may, Neeraj, if there is no rate cut in the August policy, but the governor sounds dovish, saying that, if inflation surprises on the downside, etc., how will the bond markets react? Because bond markets have been, completely ignoring any chances of rate cut or low inflation. They're still sitting at 6.3, a good 15 basis points higher than the low before the June policy. Do you see any fall in bond yields?
Okay, let me just answer this in terms of what the expectation of bond market from MPC is. I think the base case or the general expectation is for no rate cut in August. Obviously, the tonality of the MPC and the language around the forward-looking view on inflation, the forward-looking view on growth is what the market will be watching out for. And I think given what we've seen in terms of data and given the commentary that even Samiran talked about, I think there is a case that you could build a case for an October rate cut, but I think between August and October also we'll have some more data. So my guess is that the Reserve Bank would likely wait until October, see data between July, August and October and see how things are playing out, particularly on the growth fund, before taking a call on the October rate cut. As far as bond market is concerned, unless and until it gets a very clear signal from Reserve Bank that the next rate cut is going to happen, I don't expect a meaningful slide in bond yields. I think we will be in a very range-bound mode, around 6.25% to 6.3%. All the positives have been discounted. Good liquidity has been discounted. If anything, the overnight rates are now going to inch up towards 5.5 possibly. So I don't see a significant positive momentum, but at the same point in time, no reason for yields to actually go up from where we are right now.
Okay. Well, we'll have to leave it at that. I might just tell you that there's one more positive. One person told me before, when I was preparing for this interview, that the borrowing calendar for the next second half may have much fewer 30 to 50 year tenor because, you're getting such an attractive rate at the lower end. The government may rethink, or the RBI may advise it to bring it down. Then there is a bit of a rally perhaps at the steeper end of the curve. Let's wait and see. Many moving parts here. Samiran, Neeraj, thank you very much for continuing with this conversation and helping our understanding of what to expect from the Reserve Bank in terms of inflation and growth numbers, as well as how the bond market will behave. That's it on this edition of Indianomics. Thanks for watching.